Henry, here in the United States, financial conditions have been tightening.
They're actually easing, though.
Very, very recently.
Yeah.
Right? Yes.
So what's happening, though, is with rates being down until recently, credit spreads until recently being down, and then the dollar. So the Fed is in action. But to date, actually, financial conditions are easier today than when the Fed started raising rates at the beginning of this cycle.
Right.
And so our view is the Fed will continue to raise rates. I think economic growth is solid, but also you look at net worths at a record. I think there are things that they want to do to send a signal that, particularly where credit spreads are, that they're not going to leave the punch bowl at the party for too long. Well,
when you look at the backup that we saw last week in high yield spreads in particular, do you draw any conclusions from that, or is that?
I do. I mean, actually, a couple of things I would say. One is, to us, high yield spreads is one of the single biggest indicators we look at. Two is we run an implied default monitor, and before last week, it was essentially saying that the implied default rate on high yield was 1%. And just to put that in context, in January of 16, it was 8%. So the market has gotten quite constructive. So as an asset class, we have
complacent.
I think complacent's a good term. I think as a firm, we manage a lot of bank loans, levered loans. We're trafficking in that all the time. Our portfolio managers have moved into other areas right now. And that's true in Europe. I mean, if you look in Europe today, the high yield bond is yielding less than the dividend yield on European stocks. So if you just take a step back, that seems a little bit offsides to me.
Okay. At the same time, notwithstanding this backup in credit spreads, valuations, right, almost across all asset classes are on a relative basis still very rich.
I think that's the headline, but I'll give you a more optimistic view, which is this environment reminds me a lot of the late 1990s. It's not like the 2006, 2007. In the late 1990s, you had a lot of investors chasing growth and chasing kind of simplicity, and they left things that had kind of problems around them. And
the hairy stuff.
And that today is what's happening. And, we're 9 years into a bull market, and you still have actually over half the Russell 2000 is trading less than 10 times EBITDA. And obviously that's not cheap, but relative to a 9-year bull market, that's pretty incredible. And,
people forget that stuff when they look at the valuation, the PEs on the FANGs.
It's the same thing. The consumer net worth looks incredible at a record, but when you look underneath, the majority of Americans haven't had real wage growth in 2 decades. So to me, it's this whole bifurcation. Our mantra internally is kind of buy complexity, sell simplicity. The one area I'd say in the equity market, we certainly are quite constructive on Asia. Japan is a very big market for us, and we also see, I think we had talked about this last time, we've been calling for a turn in emerging markets. We now actually think we're entering a mid-cycle of the emerging markets. So, if you snooze, you'll miss it. But I mean, right now it's actually performed well. Things are happening fast. We think that will continue for the next couple of years. And implicit in what I'm saying is a view on the dollar, that we think the bull market and the dollar has largely run its course.